sizing here. And these are just examples. Since we talked about crude last, let's talk about crude oil here. And let's say these are two examples with the full size contract on the top here and the mini on the bottom. So what this is really just a sliding scale that gives you a quick reference guide to how many contracts you can trade based upon the risk that the trade requires. So again, talking about that whole know what your risk is before you take your trade, here's a great example. So if we look at this table here, we can see that the average is around 30 ticks, and the account size here in this example is 100,000, and the top row is the 3% risk, bottom row is 2%, or excuse me, middle row is 2%, and the bottom row is 1%. So if I feel that I only want to risk 2% of my overall NAV on my account, and the trade itself requires a risk of 30 ticks per contract, I'm going to only take 6 contracts on that trade. Whereas it's very, very low risk on the trade, and I feel I'm willing to risk 3% simply because of I'm very confident in the trade or whatever. And 20 tick risk per contract, I'm going to take 15 contracts on that trade. So you can see it's a very large sliding scale, and you can use these percentages obviously at your discretion. But if you're having a hard time in your trading, and for whatever reason you're dealing with some drawdown, and you're still, let's just say, at 100,000 or whatever, but the risk is 30 ticks per contract, or $300 a contract. You should only take 3 contracts on at that point. And anything above 35, 40, that's pretty extreme. So obviously you want to trade a lot smaller of a size on that. But let's just say that you're very confident in a trade, and for whatever reason you missed it, and the risk now increases because you want your stop to be placed at the right location still. So you obviously have to take a smaller position. So very straightforward. And then when we look at the mini, it's the same thought process. Obviously the ticks are going to be different because it's really half of what crude is, and they trade in different increments, $12.50 per tick rather than $10, or excuse me, well, it is $10 or 10 cents there per tick, like crude offers, full size I should say. But again, $10,000 account, and I want to trade risk 3% of my NAV. That's about $300 as a whole, and the trade itself requires 15 ticks of risk. Unfortunately, you can only trade 1 contract, and that's being very aggressive. You could actually, keep in mind these are rounded, so you obviously can't trade fractional contracts. So 1 contract for either 1 or 2, or excuse me, 2 or 3%. Will allow you to do that, but that's kind of the max as far as you're only risking 2% there. You can only trade 1 contract there, but if the risk is beyond that amount, that's it. You can't even take the trade. It's just too expensive for you. Or unless you are willing to risk more of your account. So that's the thinking, is having some sort of a quick reference. Obviously, at some point you'll have this memorized, but it's helpful to establish some sort of quick reference in your trading decision making before the trade happens, so that you aren't caught, for lack of a better word, with your pants down on a big move that goes against you, and you're taking on way too much risk. You just don't want to get nailed. That's the whole important point I'm trying to make here, is you got to manage your risks first and foremost.